The bull market is still in full effect. In fact, it could be early stages of this bull market, and today I'm going to prove it to you. Now, there's a series of indicators I watch to help me time the market. These are things that show up every time the market begins to weaken and roll over, and if you know what to look for, you can sidestep these periods of market weakness and be sure you stay in when conditions are good, like they have been over the last 6 months. So I want to walk you through those today, show you what I'm seeing, and lay out my case for why I believe the market is still strong and you still want to be long. Now, this is a chart of the S&P 500. You can see we're in a very nice uptrend as we have been since mid-April. Now, the average investor, their analysis stops right there. They say, things are going up, I should buy. That's why the average investor loses money. We're going to go much deeper. Now, obviously, it's been a rocky couple of days here. Trump tweeted on Friday that he's going to place a 100% tariff against all Chinese imports. He kind of walked that back over the weekend, so we've been a little bit choppy. But look, when you're in a stock market that's up 35 to 40% over the last 6 months, heads up, there's going to be some people that are gun shy, and any little sign of weakness, they're going to jump out. So don't be surprised you're getting a bit of volatility right now. But let me walk you through what I look at and what I'm seeing that gives me confidence the market is still strong. So the first thing is the advanced decline line. And this is the S&P 500 index on top, the advanced decline line on the bottom. And the advanced decline line just takes every stock in the market across the major exchanges and says how many went up today and how many went down. And obviously, in a healthier market, more stocks should be going up than down. And so it says, all right, well, 3,000 stocks went up today, 2,500 went down, so the net reading is plus 500. And it just adds that reading on the previous day's reading. And so what the advanced decline line does very well is both warn you when markets are weakening beneath the surface and let you know when they are, in fact, stronger than people realize beneath the surface. And this is a great example of that. This is the tariff sell-off when the market went bear February, March, and April, earlier this year. Big 20% drop in the index. But I want you to notice how soon it took the market versus the advanced decline line to reach new highs. By the end of April, the advanced decline line was here already making new highs. Meanwhile, the index was still well below its highs. So it was showing you there's a lot of strength here, and this market rally is real, and you want to be involved. And this has, of course, led to one of the strongest stock market rallies in modern history. Now, to contrast that, if we go back here to right before the 2022 bear market, let's just put these up here. Okay, let's zoom in here. Now, notice here how in late 2021, the final 6 months of 2021, the index was rising, steadily pushing higher. But the advanced decline line down here below was not. It was moving sideways. And here's what's happening. You see, indexes are market cap weighted. That means if NVIDIA and Tesla and Google and Microsoft and Apple and all these 8 or 10 big guys, if they're all going up, the whole index is up. If they're all going down, the whole index is going down because the bigger the company, the more weight it has in that index. And the problem lies in that we get situations like this where the Mag 7, the big mega cap stocks are rising, dragging a whole market up with it. But meanwhile, it is actually weak beneath the surface. The other 5, 6, 7,000 stocks aren't knocking it out of the park the same. And so this, of course, was your warning that the markets are actually weaker than they appear. And, of course, that led to the 2022 bear market, as you see things teetered off. So that brings us to today, and I just want you to see here that the advanced decline line is actually holding up very well. It's, in my opinion, holding up better than the overall index. It didn't even break down beneath these lows from a couple of weeks ago, and it's just a tick off the highs. So no signs here that things are weakening beneath the surface, and it is time to get out based on the advanced decline line. Okay. Now, the next thing I look at is the net new highs. This is similar to the advanced decline line, but it looks at how many stocks made a new high for the year and how many made a new low for the year. And again, it just gives you a net reading. We can see yesterday's number in this white box over here to the left. 259 stocks made a new 52-week high, and 39 stocks made a new 52-week low. So the net reading was 220. And again, we're just looking for participation. In a strong, healthy market, it stands to reason there should be more stocks making new highs for the year than making new lows for the year. And so you want to see that participation. Now, while there are the occasional down day, we had this little one here, May 22nd, another nasty day here in August. This one, September 25, and of course, this most recent Friday when Trump tried to shock us all with his China announcement. But it comes ripping right back, and what you want to be weary of, and what should give you pause when you see 3, 4, 5 of these in a row. And so, like, for example, this was when the tariff war started. 1, 2, that's 3 days in a row here. 4, 5, 6, 7. Like, this would have warned you very early on. Things are not looking so great. Maybe I should cut my exposure. And if you did, you just sidestepped what was a pretty nasty and vicious bear market. Okay, so net new highs again popped right back to strong, plus 220 yesterday. No signs of weakening beneath the surface. Now, another thing I look at, and this is not something that's really easy to quantify, but it's where is the strength in the market? If you've been following me for a while, you know that my overarching theme is to laser focus on the top performing areas of the market, the sectors and subsectors where big money's flowing into, and focus on those stocks. And so when we look at the areas that are outperforming over the last 1 and 2 and 3 months, when the market is shifting, when Wall Street is getting out, you'll see rotation, all right? And you'll see that you'll see the money go from like high risk areas to low risk areas. So nuclear, biotech, solar, clean energy, semiconductor. These are big growth areas. If you went back and looked at this in March before the sell-off, you'd have noticed the money was going into insurance stocks and consumer staples and basic materials, like just really boring salt of the earth stuff that doesn't tend to move as much and ebb and flow with the overall market. But that is not the situation here. So if you start to see these areas that have been outperforming, and it's been quantum and nuclear and mining, utilities is coming up as we see this energy squeeze happening in the AI space, that's been the leading areas, and it's still the leading areas. So until we see those come off and we see some traditionally safe haven areas begin to rising up the ranks, I see no reason to fear. Another thing I look at is the percentage of stocks above the 200-day moving average. Now, I've got this. So this is the U.S. Composite Index on top, just the general market index. And again, below is the percentage of stocks on the NASDAQ exchange that are above the 200-day moving average. Now, why does this matter? Well, the 200-day moving average, and I'll just slap it on this chart here, is really the big line in the sand. This is the 200-day moving average for the overall market index. And you can see how in a strong market, this is following COVID, tends to stay above it. When it breaks below the 200, usually bad times. When it gets back above it, long-term uptrend, get under it, back above it, right? And you can do this for any stock. I mean, you can look at NVIDIA, you can look at Apple, you can look at any stock, and you'll pretty much see that when things are above the 200, they're trending higher. When they break below it, they're going lower, okay? So it's a big institutional level they watch. It's one the quants use. It's one that systematic traders use, and it's just something they use to identify stocks in long-term uptrends, okay? And so while you're not going to see this continually rising, I mean, you can't go above 100% of stocks, so it's not like this thing's going to just climb forever, but you want to see it stay consistently up in positive ground. And I put a red line, the 50 mark. Anytime it's below that, it means less than half of NASDAQ stocks are above this long-term moving average. And if you go back and look here, I mean, yes, it has little dips. But for the most part, as long as you're 50 to 70% above, the market is pushing higher. When it broke below 50, and you are seeing real weakness, and that was right in here, that would have tipped you off right in here as the market started to roll. And again, you could have sidestepped a lot of this nastiness in the market. So that brings us to today. And we look at this number, and it's currently 62.5. So yes, of course, it dipped here on Sunday a little bit. On Friday, everything sold off hard, but it's bounced right back. And it is sitting up here in this 60 to 70 range where we have been holding for the bulk of this rally. So once again, no sign of weakening happening here, but this is something I like to keep an eye on. And finally, and this is the only thing that really is showing me a bit of weakness, is the high yield index. So NASDAQ composite, Fed funds rate. Let me show you something. In red, that is the 10-year government bond yield. And in green on the bottom is the high yield index. And let me tell you the difference here. So government bonds are risk-free. If you buy a bond, you loan money to the U.S. government, they are going to pay you back. They'll tax the citizens. They'll print the stuff if they have to. It is without risk. That's why it's known as the risk-free rate. But if you lend money to a business, especially a smaller or newer or business in a riskier industry, you are going to charge them a higher interest rate because you're taking on more risk. So what the high yield index does is it takes interest rates with a risk layer on it. And when you go back, and for example, like this is earlier this year with the tariff situation. Okay, so notice here, as soon as Trump basically declared war on the economic world and slapped 40 and 50 and 80 and 100% tariffs, suddenly a lot of businesses looked a lot riskier. Those who bought their raw materials or their goods from another country now might be paying big tariffs on that. If you sell a lot of your goods overseas, those countries are likely to place retaliatory tariffs. And so what may have been a very safe business suddenly looked pretty risky. And banks and financial institutions responded by charging higher interest rates to borrow their money under those conditions. And so we saw this really start kicking up February, early March, and then it just went parabolic into April. But of course, it has been declining ever since as financial conditions have kind of loosened up. It's easier to borrow money, do so at a lower rate, and that is, of course, added to the rising stock prices. Because all things being equal, as interest rates come down, stocks will go up. And as rates go up, stocks will go down. When you're getting 7 or 8% in a money market account, stocks are going to need to be pretty enticing to pull you over there, right? So the prices have to come down and get competitive. On the other hand, if you're suddenly only making 2% a year at your bank or in your money market, the stock market looks more appealing. Valuations go up because there's less competition. So that's the interest rate versus stocks correlation here. And I say all that in a long-winded way to say this little thing's going up a little bit, okay? It has ticked up. Now, not huge. It's gone from 6.5 to like 6.7. It was at 6.8. So it's about 25 basis points up. And we saw a little move like this in July. We saw one of these moves in September. So I don't want to hit the panic button yet. But if this were to break out and get above 6.9 or 7, that would be the first real warning sign for me. I'd probably begin pulling back, reducing exposure. We want to see us to settle back in here into the low to mid sixes and potentially take out that low and push lower. So this is probably the only thing I would say, it's not super bearish yet, but it's not super bullish like every other indicator. Okay, but those big things, the advanced decline line holding up and pushing higher, the net new highs and lows staying strong in green, the areas showing strength remaining high risk, more volatile growth areas, the percentage of stocks of the 200-day holding the 60 to 70% range, and interest rates, although they have ticked a bit higher, still very much on a low end of the range over the last several years. So all of this combined points me in the direction it says the bull market is still in full effect. Now, this is as of today, Thursday, October 16th, 2025. Obviously, anything can change. There could be a once-in-a-generation global pandemic. There could be a trade war. This stuff comes out of left field, and we can't see it coming. But the indicators I've shown you here historically have allowed you to time the markets pretty well. And if you're in tune with them, you review these, say, once a week, you'll see the market weakening long before the indexes begin to fall. However, when they are all strong, when they're doing what we want and showing us that the things are strong beneath the surface, I tend to keep my foot on the gas and stay long. Are stock prices a little extended now? Absolutely. Are valuations way too high? Probably. But the stock market has an uncanny ability, and they've been doing this for decades, an uncanny ability to embarrass the greatest number of people. And when everyone thinks it's a bubble, things are too high, it's time to get out, it usually goes a lot higher. Vice versa, when everyone says the economy is garbage, I don't trust this Trump guy, this is imploding, the market's going to crash, I got to be out. That's usually right around the low and the best time to buy. So do with this what you will. So I have learned over the last 20 years not to trust my intuition when it comes to timing the market. I instead stick to these indicators, these data points that have historically always been one way in a strong market and another way in a weak market. And by doing that, it makes this much more mechanical. Now, if you're interested in this, I did do another video going through each of these in much more depth. I gave you the ticker symbols, how to put all this stuff in your TradingView account. It's all free, by the way. I'll link that video here if you want to watch that. I encourage you to do so. And if you haven't already, hit the subscribe button, like this video. That way, these will show up in your feed going forward, and you won't miss future updates.